When you decide whether traditional or Roth is right for you, you have to first understand the differences between the marginal tax rate and the effective tax rate. Just because you're making $100,000 a year, it doesn't mean that you're going to pay all 22 or 24% of $100,000 to pay the federal income tax. You should know what your current marginal tax rate is and how your effective tax rate is calculated. And let me break it down for you. So your gross earnings are what you earn before taxes and deductions. If your hourly rate is $40 per hour, working 40 hours a week, then your annual salary is $83,200 and your monthly gross earnings are almost $7,000. And let's say you have healthcare, dental, vision, and other pre-tax expenses taken out of your gross earnings, and that leaves you $70,000 in taxable income. I want you to remember these two terms. You have gross earnings of $83,200 before taxes and deductions, and you have $70,000 in taxable income after deductions but before taxes. Then the next step you need to know is if you're filing your taxes as a single individual, a head of household, married filing jointly, or married filing separately, your tax bracket will fall in one of these depending on your life situation. And knowing your tax filing status will help you understand what your current standard deduction will be for the current tax year. For 2024, the standard deduction has increased by 5.4% from 2023. An increase in standard deduction means that you get taxed less every year due to inflation. Your $100,000 in taxable income from the previous year is going to be taxed 5.4% less than the year before. That makes sense so far, right? So the standard deduction for single individuals and married individuals filing taxes separately is $14,600. So the first $14,600 that you earn is considered tax-free. The standard deduction for married couples filing their taxes jointly is $29,200. If you're a head of household, your standard deduction is $21,900. The standard deduction is a figure that is set by the IRS every year that can be subtracted from your taxable income. And I will make an updated video every year so that you're all aware of what your tax situation is going to be. So for example, if you're making $100,000 a year as a married couple, then your taxable income in 2024 with the standard deduction is going to be $100,000 minus $29,200, and that's not counting any of the pre-tax deductions that I mentioned earlier. So your total gross earnings are $100,000 and your total taxable income is going to be $70,800 in this example. Your total taxable income could be a lot lower if you make or traditional 401k contributions, healthcare premiums, or health savings account. And if you're over the age of 65 or legally blind, you will get an additional $1,550 per person for the standard deduction, or $3,100 for married couples if you're 65 years old and or blind. And if you're single and or head of household, you're going to get an additional $1,950 or $3,900 if you're both 65 and blind. Let me give you an example in this scenario. So if the husband is 65 years old and the wife is 65 years old and blind, assuming that they're going to file their taxes jointly in the year 2024, their standard deduction is going to be $29,200 plus $1,550 for the husband for being 65 years old, plus $1,550 for the wife for being 65 years old, and another $1,550 for the wife for being blind. And that's going to come out to a total of $33,850 just in standard deductions for age 65 and older, and if one of you or both of you are blind. And their taxable income is going to be subtracted significantly with the increased standard deductions. And the standard deduction for dependents is going to be $1,300 or your earned income plus $450, whichever is greater. Just remember that the amount can never be greater than the usual standard deduction available for your filing status. Make sure to get with your local CPA if you're not clear about your tax filing status. for your dependents. And these are the marginal tax rates for the tax year 2024. Remember that these dollars are for your taxable income and not your gross earnings. Your taxable income after you deduct the standard deduction or itemized deductions, right? Your taxable income is after you deduct the standard deduction or itemized deductions. So if you're single making $47,000 a year, your first $11,600 is taxed at 10%, and the next $36,000 is taxed at 12%. If you're married making $150,000 a year jointly, your first $23,000 is taxed at 10%, and the next $71,000 is taxed at 12%, and the remaining $56,000 is taxed at 22%. So your tax threshold is much higher if you're married and filing your taxes jointly. Because if you look at single individuals, head of household, and couples filing their taxes separately, your income between $100,000 and $192,000 will already put you in the 24% tax bracket, when couples file their taxes jointly are still at the 22% tax bracket. That 2% difference really makes a big difference with thousands of dollars. And you could very much be in the 32% tax bracket if you're single or a head of household if your taxable income exceeds $192,000. But just remember that it is a progressive tax system. So not all of your $192,000 would be taxed at 32%. Your first $11,000 is taxed at 10%. The next $36,000 is taxed at 12%. The next $53,000 is taxed at 22%, and then the next $91,000 is taxed at 24%. By the way, I am so fired up to announce the launch of my private FIRE community for people just like you and me who are passionate about investing, saving, and achieving financial independence and exploring different possibilities to retire early. My private community will allow you to connect with me on the platform and get in touch with other like-minded individuals or couples who are just as serious as you are with the FIRE movement. As a member of my private community, you'll get resources like investing, saving, paying off debt, or finding the right place to grow your money. And this is the 2024 tax bracket for single taxpayers. And let's assume that the income is $70,000 in 2024. The income thresholds for the marginal tax rates are going to increase every year to adjust for inflation. So your first $11,600 will be taxed at 10% or $1,160. And the next $35,549 will be taxed at 12% or pretty close to $4,300. And the remaining $22,851 out of that $70,000 income is taxed at 22% or $5,027. So your total effective tax will be $10,453, and that's how much you would owe to the federal government based on the 2024 numbers, making $70,000 a year in taxable income. And your effective tax rate is 14.9%. That's your effective tax rate or effective tax divided by your taxable income. Your marginal tax rate is 22% because that's the top tax bracket you're at, but your effective tax rate is almost 15%. And take a look at the tax bracket for married filing jointly. And let's assume that your gross income is $179,200. After the standard deduction of $29,200, your taxable income is $150,000, assuming that you have no dependents. So the first $23,200 is taxed at 10% or $2,320. The next $71,100 is taxed at 12% or $8,532. And the remaining $55,700 is going to be taxed at 22% or $12,254. So the total effective tax for this couple will be $23,106. And if you divide it by $150,000 in taxable income, not $179,000 in gross income, you're going to divide that by $150,000 in taxable income. It's going to give you 15.4%. And your marginal tax rate is at 22% because that's the top tax bracket you're going to be at as a married couple filing taxes jointly. And just to recap on the differences between marginal tax rates and effective tax rates, The tax brackets I just showed you are the marginal tax rates. Your effective tax rate is the average amount of taxes you're going to pay. Your W 2 employer is already deducting your tax from your paycheck based on what you selected on the Form W 4 if you're single, married, or head of household. If you're not withholding enough, you might end up getting penalized by the IRS when you file your taxes. Any additional taxable income on top of your top W 2 income is going to be taxed at your marginal tax rate. It's important that you understand where you are in your tax bracket and how much you will owe if you receive a non qualified dividend income, short term capital gains, or real estate income.